Before we get started, a quick reminder. If you enjoy our content, don't forget to hit the like button, subscribe to our channel, and leave your comments below. We appreciate your support. Now, welcome to Wealthwise, your guide to smart and strategic investing. We're dedicated to empowering you with the knowledge and strategies to take control of your financial future. Today, we're taking a deep dive into the world of advanced investment strategies. So grab a cup of coffee, sit back, and let's get this show on the road. Welcome back to Wealthwise, where we empower you to take control of your financial future. Today, we're going to elevate your investing prowess by delving into the world of advanced investment strategies. These aren't your everyday buy and hold tactics. We're talking about robust methods that can potentially bring you higher returns and reduce risks. You see, investing is not just about picking the right stocks or bonds. It's about how you manage your overall portfolio. That's where advanced investment strategies come in. They provide you with a roadmap to navigate the unpredictable terrain of the financial market, helping you make informed decisions that align with your financial goals and risk tolerance. One such strategy we'll explore is diversification, a technique that spreads your investments across various asset classes to reduce risk. Think of it as not putting all your eggs in one basket. Instead, you're spreading them out across several baskets, each representing a different type of investment. Next, we'll add a layer of sophistication with dollar cost averaging. This strategy involves investing a fixed sum of money at regular intervals, regardless of the market's ups and downs. It's a disciplined approach that can smooth out the effect of market volatility and potentially increase your long-term returns. We'll also delve into the art of tax-efficient investing, a strategy designed to minimize your tax liability, thus maximizing your net returns. After all, it's not just about how much you make, but how much of it you get to keep. And let's not forget about market timing and risk management. We'll tackle the million-dollar question. Can you really predict market movements? Plus, we'll arm you with essential risk management techniques to shield your portfolio from potential market downturns. In the world of investing, knowledge is power. By learning and applying these advanced investment strategies, you'll be in a better position to grow your wealth and achieve your financial goals. Ready to supercharge your portfolio's growth potential? Stay tuned. First up, let's unravel the power of diversification. You've probably heard the old adage, don't put all your eggs in one basket. Well, in the investment world, that translates to diversification. But what does it mean exactly? Diversification is essentially spreading your investments across different asset classes, like stocks, bonds, real estate, and possibly even commodities or cryptocurrencies. The key here is that these asset classes usually don't move up or down at the same time or at the same rate. So, if one sector takes a hit, your other investments could still be performing well, balancing out the overall impact on your portfolio. Imagine you're a tightrope walker. Diversification is like having a safety net below you. It won't prevent falls, but it can certainly soften the landing. It's a risk management strategy that can help you weather the ups and downs of the market. But here's where it gets interesting. Diversification isn't just about spreading your investments, it's also about how you spread them. It's not enough to just invest in different sectors or industries. It's important to diversify across different types and sizes of companies, different countries, even different styles of investing. For instance, investing in both growth stocks, companies expected to grow at an above-average rate, and value stocks, companies that are underpriced according to their intrinsic value, can add another layer of diversification to your portfolio. Similarly, including both domestic and international investments can protect you against downturns in any one country or region. But remember, while diversification can help reduce risk, it doesn't eliminate it entirely, and it doesn't guarantee profits. But by spreading your investments wisely, you can improve your chances of achieving stable and consistent returns over the long run. So, diversification isn't just about spreading your eggs in different baskets, it's about choosing the right baskets. And that, dear listeners, is the power of diversification. Now, let's delve into the magic of dollar cost averaging. This is a simple yet powerful investment strategy that has stood the test of time. It's all about consistency and discipline, not market timing or quick wins. So what is dollar cost averaging? It's an investment technique where you consistently invest a fixed amount in a particular investment, like a stock or a mutual fund, at regular intervals, regardless of the price. This could be weekly, monthly, or quarterly. The beauty of this strategy is that it naturally smooths out the price you pay for your investments over time. When prices are high, your fixed investment buys fewer shares, and when prices are low, it buys more. This results in an average cost per share over time, hence the term dollar cost averaging. Why is this beneficial? Well, it takes the guesswork out of investing. It's not about trying to time the market, which even the most experienced investors struggle with. Instead, it's about sticking to a consistent investment plan, regardless of market conditions. This discipline can help investors avoid emotional decision-making, which often leads to buying high and selling low. Moreover, dollar cost averaging can be a great way to build wealth over the long term. By consistently investing, you can take advantage of the power of compounding, where your earnings generate even more earnings. This is particularly effective in volatile markets, where the strategy can lower the average cost per share, potentially boosting your long-term returns. However, like all investment strategies, dollar cost averaging isn't without risks. It doesn't guarantee a profit or protect against loss in declining markets. Therefore, it's important to consider your financial situation and investment goals before implementing this strategy. Remember, dollar cost averaging isn't about timing the market, it's about time in the market. It's about investing consistently and patiently, allowing your wealth to grow over time. By doing so, you can smooth out market volatility and potentially boost your long-term investment returns. Now that's the magic of dollar cost averaging. Before we move on to our next strategy, we'd like to take a moment to remind you to interact with our channel. If you're finding our content valuable, please hit the like button below. It really helps us out and lets us know you're enjoying the content. Also, if you haven't done so already, consider subscribing to Wealthwise Media. We regularly share insights and strategies to help you make informed investment decisions. And of course, if you have any questions or thoughts about what we've covered so far, don't hesitate to leave a comment. We love hearing from you and strive to create content that serves your needs. With that said, let's dive back into our advanced investment strategies. Up next, we're going to explore the art of tax-efficient investing. Stay tuned. Next, we dive into the art of tax-efficient investing. It's an essential part of any successful investment strategy, and yet it's an area that's often overlooked. So, what exactly is tax-efficient investing? Well, in a nutshell, it's about structuring your investments in a way that minimizes your tax liability. Let's break it down further. Say you've got two investments. Both offer the same return, but one is taxed at a higher rate. Which one will leave you with more money in your pocket at the end of the day? Naturally, it's the one with the lower tax burden. That's the power of tax efficiency. So, how can we achieve this? Well, there are several strategies that can help. First off, consider tax-advantaged accounts. These include things like individual retirement accounts or IRAs and 401k plans. These accounts offer either tax-free growth or tax-free withdrawals, depending on the type. Another strategy is tax loss harvesting. This involves selling off investments that have decreased in value to offset the taxes on the gains from your other investments. It's a bit like making lemonade out of lemons. Then we have asset location. This strategy involves putting investments that generate a lot of taxable income, like bonds, into tax-advantaged accounts. Meanwhile, investments that generate less taxable income, like stocks, can be held in regular taxable accounts. Lastly, there's the buy and hold strategy. This one is as simple as it sounds. You buy an investment and hold on to it for a long time. This way, you defer paying taxes on your gains until you sell the investment, which ideally would be when you're in a lower tax bracket. So being tax efficient isn't just about saving money, it's about making your money work harder for you. And who doesn't want that? Ever wondered if you can predict market movements? Let's talk about market timing. It's a concept as old as the stock market itself, a tantalizing idea that you can buy low, sell high, and maximize your returns. But is it really that simple? Well, the truth is a bit more complicated. Market timing is based on the premise that you can predict future price movements, which is exceedingly difficult even for seasoned financial experts. Why? Because markets are influenced by an intricate web of factors, from geopolitical events to corporate earnings reports, from macroeconomic indicators to even the mood of investors. Predicting the timing and impact of these factors is like trying to predict the weather a month in advance. On top of that, to succeed at market timing, you not only need to predict when the market will fall, but also when it will rise again. That's two extremely difficult predictions you need to get right, consistently, to make market timing work. Studies have shown that missing just a few of the best days in the market can significantly dent your returns. Additionally, the cost of frequent buying and selling can eat into your profits, not to mention the stress and time involved. So, what's the alternative? It's sticking to the fundamentals. Diversify your portfolio, invest regularly, hold for the long term, and adjust your investments based on your financial goals and risk tolerance. This approach may not have the thrill of trying to time the market, but it's proven to work over time. It's important to remember that investing isn't about getting rich quick. It's about growing your wealth steadily and sustainably. In the world of investing, slow and steady often wins the race. The truth about market timing, it's less about perfect timing and more about solid investing principles. Finally, let's discuss essential risk management techniques. The world of investments can be a roller coaster ride. Markets can surge skyward one day and plummet the next. This is where risk management comes into play. It's the process of identifying, assessing, and prioritizing the potential risks that could negatively impact your investment portfolio. Risk management isn't about eliminating risks altogether. That's practically impossible. Rather, it's about understanding the risks you're exposed to and making informed decisions about the level of risk you're comfortable taking on. There are 3 key steps in risk management: identifying risks, assessing their potential impact, and implementing strategies to manage them. Identifying risks involves recognizing the various types of risk that could affect your investments. These can range from market risk, where the entire market declines, to specific risks related to individual investments. Assessing risks is about understanding how these identified risks can impact your portfolio. This often involves some number crunching, examining historical data, and using statistical measures like standard deviation and beta. The final step, managing risks, is where you decide what to do about the risks you've identified. This could involve diversifying your portfolio, setting stop-loss orders to limit potential losses, or rebalancing your portfolio to maintain your desired level of risk. Risk management is an ongoing process. It isn't something you do once and then forget about. It needs to be a regular part of your investment strategy. The markets are always changing, and so too are the risks they present. In the end, effective risk management can help you protect your portfolio against unexpected market downturns and economic crises. It can provide a safety net, allowing you to weather financial storms and keep your investment goals on track. Remember, risk management isn't about avoiding risks, it's about understanding and managing them. Let's recap what we've learned today. Advanced investment strategies are not just for finance gurus or Wall Street wizards. Anyone looking to maximize their portfolio's potential can utilize these tactics. We kicked off our journey into the world of advanced investing by delving into the power of diversification. By spreading your investments across a variety of asset classes, you can mitigate risk while potentially increasing returns. Remember, don't put all your eggs in one basket. Next, we introduced you to the magic of dollar cost averaging. This strategy involves investing a fixed amount regularly, which can smooth out the effect of market volatility and lead to long-term gains. It's like taking a steady, consistent path up a mountain rather than trying to leap to the top in one bound. We then explored the art of tax-efficient investing. By understanding how to minimize your tax liability through smart investing decisions, you can keep more of your hard-earned money working for you. It's not just about what you earn, but also what you keep. The truth about market timing came next. While it's a tantalizing idea to try and predict market movements, we unveiled the surprising reality that it's more about time in the market than timing the market. Patience, it turns out, is indeed a virtue in investing. Finally, we took a deep dive into the essentials of risk management. By employing techniques to protect your portfolio against unforeseen market downturns and economic crises, you can safeguard your investments and weather any storm. Incorporating these advanced strategies into your investment approach can help you achieve your financial goals faster and with greater confidence. The world of investing is vast and varied, but with these tools in your arsenal, you're well equipped to navigate it. Thanks for tuning in. As we wrap up, don't forget to hit that like button, share this video, and subscribe to Wealthwise for more expert tips on personal finance and investing. We'd love to hear about your investing journey and any questions you might have, so leave us a comment below. Until next time,